Fair value accounting. This is an interesting concept because of the damage it's done. It is a relatively new accounting rule as currently interpreted. And the reason that's significant, we've had accounting since at least the Egyptians, 5,000 years. So if you have a new rule, you need to be able to prove it's right. So the burden of proof is on those that support fair value accounting. It sounds good. It's called mark to market. The dilemma is there are times that markets aren't functioning, and we were in one of those times. I'll give you a simple example. Maybe I think my house is worth $600,000. In the middle of this crisis, the only buyer for my house would be somebody that wanted to steal it. Maybe they offer me $300,000. I'm not going to sell it. I don't owe anything on my house. I don't have to sell it. It's worth more than $300,000 to me. Under fair value accounting, however, that house has to be valued at $300,000, even though I'm a buyer and I can afford to buy it at $600,000. It really violates the idea that you have to have a willing seller along with a willing buyer. It was a major cause of the systematic disruption in the economic system. I'll tell you how that worked. We actually made these decisions, so I'm really conscious of it. There was a $100 million bond in the marketplace that was secured by mortgages. Some of the mortgages weren't paying. If you looked at the mortgages that weren't paying, the expected losses, and you ran an economic analysis, that bond ought to be worth $80 million. Okay, ought to be worth $80 million. In this locked, feared market, the only buyer was somebody that wanted to steal those mortgages, and they would only pay $50 million for it. Why didn't people like us that had plenty of money coming out our ears, why didn't we go buy those mortgages at $50 million? And if we'd done that, the prices would have started going up because it was a great economic deal. The reason we didn't make those great economic deals is we said, wow, how can we take the accounting risk? Because even though the bonds economically are worth $80 million, we don't know at the end of the next quarter, the market won't still be locked, and the bonds will only be valued at $40 million, and we'll have to take a loss and reduce our capital. By the way, this was non-trivial in terms of the capital in the banking business. Think about this. If banks had had to write down their loans to cash flow value, instead of writing down to $80 million instead of $50 million, there'd been a lot less capital destroyed. For example, if you wrote a $100 million bond down to $80 million, you use $20 million in capital times 10, $200 million in lending capacity. But if you have to write it down to $50 million, you lose $50 million in capital times 10 to $500 million in lending capacity. So a lot of the destruction of lending capacity was an accounting entry. It's just all kind of other problems that fails to consider gains. Values ought to be based on cash flows. If we'd had this in 1990 and that real estate crisis, the U.S. financial system would have failed. One important idea. People don't realize the government owns the accounting system in the United States. The SEC, a government agency, determines accounting rules. They put who's on FASB, they determine the accounting rules. Probably nobody in here runs a small business uses GAAP accounting to actually manage your business. I don't think internally, I don't know of any large business that actually manages their business based on GAAP accounting. We do internal accounting and we turn it into GAAP. Hedge funds don't use GAAP accounting. It is not a market-selected accounting system. Pick-a-payment mortgages, one of the problems of that you've seen a lot in the marketplace. Pick-a-payment mortgages where you buy a house and the monthly interest payment on your mortgage ought to be $1,000, but you only pay $500 each month. So each month your mortgage gets bigger. Great product, right? So at the end of 5 years you owe a lot more on your house than you did when you bought it. Very popular in places like Southern California, Southern Florida, Metro DC had that product. Interesting fact. The big players in the pick-a-payment mortgage market, Washington, Golden West that became Wachovia, Washington Mutual Countrywide, all which effectively failed, all financed that product with FDIC insurance. Without FDIC insurance, they couldn't have been a pick-a-payment mortgage business. BB&T chose not to be in that product for an ethical reason, not some great business insight. And I'm going to come back to this point. One of the fundamental commitments in our mission is to help our clients achieve economic success and financial security. We believe we're in the business to help our clients be successful. We expect to make a profit doing it. One of our rules is never consciously do anything that we know is bad for our client. Because even if you make a profit in the short term, it'll come back to haunt you in the long term. So we decided not to do this product, not because we saw that the real estate markets were going to collapse 30%, but because we knew they weren't going to continue to appreciate at 15% every year, and that the theory of buying too big a house and then refinancing it after 5 years was not going to work, and particularly not going to work for lots of young people. So we chose not to offer this product over ethical considerations, not some great business insight. It's an interesting thing how long-term, first, and this is related to what the final points I'm going to make, government policy can be. How do we get from the traditional model where thrifts financed a house and then held that loan in their portfolio? When I got my first loan, and I see a few gray hairs in here, I went to a local savings and loan institution, got a 20% down, I had to put 20% down, I got an 80% mortgage that was payable over 30 years. And 90% of the people in America, that's how they finance their house. That model worked for 50 years. The losses on actual home financing was very small for 50 years from that industry. And then the thrift industry was systematically destroyed by government policy. And interestingly enough, it really started with Lyndon Johnson. Lyndon Johnson wanted to have the war in Vietnam, and he wanted to have the Great Society. But he didn't want to tax people to pay for it because that wasn't politically expedient. So the Federal Reserve financed it for him. Created huge deficits, printed a bunch of money, and inflation took off. In the early 1980s, the Federal Reserve had to undo the terrible mistake they had made. They drove the prime rate to about 21%. That was not much fun. It killed the thrift industry. The thrift industry had all these fixed-rate home mortgages. They were financing them with certificates of deposit that were refinanced every 6 months or so, and they got killed in that market. And then they got some help from their friends at the government. The FSLIC was their regulator. Now the FDIC is the Federal Savings and Loan Insurance Corporation. And they did two interesting things. One, they strongly encouraged the thrifts to hedge their home mortgage portfolios. Well, the reason you can't hedge home mortgage portfolios, there's no prepayment penalty on home mortgages. So as soon as interest rates started falling, everybody prepaid their mortgages, and the thrifts lost billions of dollars in their hedges. And then they strongly encouraged the thrift industry to get into the commercial real estate lending business, financing shopping centers and office buildings where they had no expertise, and most of the remaining part of the thrift industry then failed in 1990. Interestingly enough, the reason that Golden West and people like that got into the negative amortization business was because they couldn't be in the traditional lending business. And what happened is Freddie Mac and Fannie Mae filled in the hole. They started dominating the prime residential market. And they did that because they were leveraged to 1001, they had a government guarantee on their debt, so they drove all of us, including healthy financial institutions, out of the prime marketplace. BB&T used to be a big portfolio lending of residential mortgages, but you can't compete against the government. Same thing will happen, by the way, in healthcare. Same thing will happen. We were driven out of that business. You can't compete against the government. And then Freddie Mac and Fannie Mae had created the mortgage broker model. And here's what was happening to them. Their traditional outlets were not feeding them enough high-risk affordable housing subprime mortgages to meet the goals that Congress had set for affordable housing. So they had to have somebody to do that. They created lots of local brokers, but they primarily went to people like Countrywide and Washington Mutual and said, give me lots of high-risk loans, and so we can meet this affordable housing target.